Right, it is 7 p.m. Eastern, Sunday, the 12th of July. Welcome to another unmissable Sunday show. Hi, Benny.
Hey, Squirrel, how are we doing today? Good weekend?
Lots of sport this weekend, but lots of writing as well. Now, we're going to cover a whole load of stuff this evening. I want to talk about Japan. I want to talk about this Hynix ADR. I want to talk about energy. And then you're going on an AI heater. So there's all lots to look forward to on that.
Yeah.
Okay, let's start with Japan because we had this curious announcement from Katayama on Friday around GPIF allocations, and it had a massive impact. I mean, look at that red candle in JGB 10-year yields on Friday.
The big one. Honestly, you look at that chart. Look at that. That's the biggest red candle in a year.
It's off the map, right? By quite a yeah, absolutely. Now, as we all know, Japan is the Saudi Arabia of savings, and you should never forget that. Just to put this in perspective, and my buddy Chase Taylor wrote about this weekend. So he had these two Bloomberg charts in his note, which I thought were fantastic, and he's refreshing some work that he did about three years ago. But this has been always part of my long-term yen bullishness, right? Is that at any point in time, a huge amount of global savings can be redirected back into Japanese assets.
Right.
And I mean, listen, yes, they own an awful lot of treasuries, but if you look at their percentage ownership in some foreign sovereign bond markets, it's really quite significant. Us down under, they own over in early teens of the Aussie rates market right now.
You could express that honestly in the forward market and short-term policy rate market in Japan, because the only way the yen's going to work is that those guys are serious on the short end. Obviously, these interventions are just the biggest waste of money of all time. If the average citizen understood how much money got blown just trying to reduce the descent of their currency, and that's why the long end went out. And maybe now you're seeing that they're starting to say, oh, the yen's there's going to be a point where they're going to have to act, and then the long end should you should get a flattener, basically.
Yeah, well, I mean, for me, I mean, firstly, the point about money wasted. I mean, really, it's sort of from a sort of Japan Inc. perspective. It's kind of house money, right? Because they've made so much money on foreign reserves over time. So I'm not sure if that's the right way to look at it. But we've got Dredge coming back on the show on Thursday. So
yeah, we'll get into Japan on Thursday. Yeah, for sure.
Yeah, let's save this debate for Thursday. Friday saw an amazing debut. $26.5 billion tick, just as it looked as if the memory market was rolling over. So this Hynix ADR priced at a 2.5% premium to local. I want to talk about these dynamics in a minute. Closed at a 15% premium to local. Obviously, local hadn't had a chance to move by the time this thing traded, but turnover almost 60% turnover. That's like $16.5 billion.
The brokers love that.
Yeah, it's great news for intermediaries. Listen, I used to traffic in the TSMC ADR premium over years, and this goes back, back to the turn of the turn of the noughts. I didn't have time to recreate the full ADR premium chart going back to 99 2000s, but people should understand around the ADR fungibility issue, right? Traditionally, it's pretty easy to convert the TSMC ADR into local common. Once you want to create ADRs in TSM, that you're subject to foreign ownership restriction tests, and it's really very much a heavy friction process. So there's always been a natural mid-single digit premium to the ADR. But since the whole AI world took off in November 2022, you know, the hunger for AI and chip related paper has driven, you know, this premium for TSMC is as high as 30% last year. Now it's back down at 15.5% now, which is interesting. Where Hynix closed at that almost exact same premium level. Now again, this is going to map straight over. Okay, it's different country, but there are foreign ownership restrictions in terms of ADR creation. You've got one-way fungibility into Korean won shares, but no one's going to naturally want to do that. You know, it is definitely you know, a double black diamond exercise for ADR creation, as in the gate opens and shuts, and effectively will be under the control of the depository bank.
That's a great chart. That's a great chart, though. I think that's a great way, because you saw that it was elevated during the 2020, 2021 bubble, and now you're seeing it again. It's a great, it's a, you know, it's good to collect these, like, not like intuitive, like, oh, watch ARK's price or something. Like, this is a great chart, and just like MicroStrategy's the ultimate bubble detector, right?
Yeah, but what it does do is, I mean, most people that we talk to that read our stuff are really likely only to have exposure to the ADR line of these stocks, and you know, you've got some pretty nasty potential gearing to the downside if these things unwind. It's just something to hold in the back of your mind.
So would you think about that? Would you think about that as a Taiwan dollar long? Basically, like, you're thinking about, okay,
no, because it's more than just the currency, right? This is literally the same share being worth more.
No, I understand what it is. What I'm saying is, could it be? Is there an impact in the FX market or is it just that the foreign tourists are there and you basically can arb that pretty easily?
Well, what I'm saying is,
or not arb it, but you can.
There is no arb, right? But what there there is a premium created by the mania around the current narrative, right? And so, you know, just be super careful in terms of how quickly narrative driven premium can deflate, because the natural order of life should be, you know, a 5%, maybe a 5 to 8% premium over 0000660 in Seoul, right? Anyway, switching gears. I wrote about the China collar in crude oil right now. Now, the thesis around this is pretty straightforward. You know, China has basically become, you know, a monopsony player in energy markets, and the Iran war has proven this with their ability to sort of shut off their barrel imports in order to stabilize and balance the front month crude markets, and they've just done that incredibly effectively. And I think it surprised everyone. It certainly caught all the barrel counters on the back foot. Now, the reason this is interesting is that, you know, yes, it's cut off, to my mind, some of the left tail scenarios in oil pricing. It also, to a certain extent, cuts off the, you know, cuts off the right tail, right? And so this is hence the name, the China collar. And I think, you know, while it makes sort of crude longs potentially less interesting, I think it makes energy equities really interesting here. Now, ultimately,
you're talking your book here, huh?
Well, of course. But I really do think if you are looking at effectively you know, a put and call pair over the long-term crude price as a result of China's position in energy markets, you know, a lot of the discount rates related to cyclicality of the energy sector really need to be pared down. You know, there are some, you know, it's fully integrated, diversified oil cash flows. it's the midstream guys, and I'll come back to these guys in a second, and the E&Ps. So ultimately, and also for the services guys, a structural floor under crude allows capex budgets to be underwritten, right? And so I think that's bullish for the drill ships. It's it's bullish for the E&Ps, and as I said, ultimately, if you look at the midstream guys, so this is the likes of ETs of this world, and that's the AMLP is the ETF of all the MLPs in the US, sort of US and Canadian MLPs. This thing has consistently traded at a massive discount to other sort of safe asset classes. Basically, the forward dividend stream is constantly trying to underwrite a collapse in throughputs that comes with a drop in the oil price that stops shale producers from producing. And I think over time, I have a bee in my bonnet about the valuation of so-called safe equity sectors in the US, staples being first and foremost. Utilities kind of fall into the same bucket. Why wouldn't you pay more for those MLP dividends going forward? Anyway, I wrote on that at great length in my weekend note, which came out on Saturday morning. So do look that up. And then finally, before we go on to your AI heater, Benny, I just wanted to point out where EM local currency fixed income is again back pressing new highs. This has just been an extraordinary asset class to work with over the last 2 to 3 years. And what I'm going to say is that we're talking about dots and speeches and Fed and Fed leaks and Nikki leaks and all like that. The EM central bankers just quietly get the job done, and I think that's being reflected in total returns in EM local currency fixed income. Anyway, that was my segment before you get onto your heater.
Why is it a heater?
No, you like going on your big AI charge because you've had a Pythagorean moment in the bathtub over the weekend. To be fair,
yeah. So I'll just give the background.
You've been talking to me when I haven't been writing. I've been listening to you on this topic for this weekend, Benny. So take it away.
Yeah, so it's weird because I just so everyone knows, I'm like a partner at this memory layer AI company, which is the upper stack, which I'll get to towards the end of my thing, and I also a hedge fund volatility guy, and you're truly the Benny of the Benny and the Squirrel. So I kind of bridge both areas, and I got really thinking about AI ROI because I was trying to build a cost calculator that you could instill, like an app that you could instill into your system, and then everyone could use it. I could just send it out to users, or maybe I'll sell $5 a month or whatever. And then I really started thinking philosophically about the in-depth of what AI ROI is, and it's a lot more complex than you think. And so I deep dived into this and created a formal mathematical equation of it and ran agent-based models. I really went deep on it. And it's because of this, now I have confidence that we have a clock ticking that is the AI, hyperscaler spend countdown till negative free cash flow. And then we also have a lot of debt funding, as we've talked about. But most of the conversation in the markets are the capital spending, the debt, private equity side. But what ultimately matters is AI ROI, which just gets this, just this Olay treatment of AI ROI. But people aren't really thinking about what does that actually mean. And so this will be a little bit.
Walk us through this iceberg. Walk us through this iceberg.
Right. So this is where it starts. When we think about ROI, we're thinking about, okay, state A, which is using AI or whatever it is in any classic corporate finance, versus the cost of that divided by the cost, right? And then you get a return on investment, or divide by investment, whatever you're going to say. This is just a much more difficult because everyone's been trained to think about things in tokens, token costs, right? Token cost is not the right unit at all. And then what you pay for some licenses, whether it's Claude or it's something that's on top of it, Higgs field if you're a content provider, etc. There's a lot underneath that. There's the basically total cost concept, which includes so much stuff that people aren't thinking about when they do this. So then it got me thinking, okay, well, how are we actually defining it? And what is actually we measuring it against? Because when you use a token, I think we've talked about it on the show a lot, you could say, hey, I want to do this task, but it could cost different amongst the same platform at different times. And you could have two different platforms agents, and it's wildly different. And so I think that you got to start off like, what's the atomic unit when we use these systems, whether you're an enterprise or you're the Benny the Squirrel enterprise, or, just you as an individual investor. It's like, what is the atomic unit to measure just to start, right? Because we've had slides on here. Like, a lot of guys don't even know how to measure this. And now I get it. It's the task, right? It's like,
So
what are we doing?
I know that a lot of my readers have been cranking their free Fable usage over the last week. And, trying to, for example, if they're a private investor, they're trying to create a format for getting a consistent first draft research report on a new individual stock, right? And this is what you're talking about. A repeatable task, you want it to be done exactly the same way every single time.
Right. So that's a good example. And since this is a finance-oriented show, and I don't want to bog you down too much with like AI, LM math, like you're like, okay, I want to look up SK Hynix, right? Since we started the show with this. All right. And then I want to have a process. So you have to build a skill, which is like a .md file of exactly how to prompt it. Like, that's super important. Like, if you just speak like I'm speaking or the squirrel's speaking, you're not going to get good results, and it's not going to be consistent. So like the first thing you got to do when you use these things is ask the system, how do I best prompt this question? Like, that's the first thing you should always do. And once you will get your muscle memory going, that's how you always should start of ask the system how to ask the question. And like, it's, it's a weird thing because humans obviously don't do that, but we're not talking to a human. We're talking to a machine. Right. And so then you think about it and we go back. Hang on, let me add it back. Was this but basically I created a framework and defined what a task is and all the fail safes along it. So I'll just run you through the 8 factors. You think about it, like every domain is different. If you're doing research like Benny is, I'm going to do a lot of stuff that I never monetize, which if you're a COO or a CFO, you're going to be like, well, that's a waste of money. So, but I don't think it's a waste because now you guys are getting stuff like this that would have took me a lot longer if I didn't have the assistance of this, or a lot of research I do, it speeds it up. But at the same time, like, how do we measure? Like, for me, that's invaluable. If you're an accountant trying to do tax returns, it's wildly unvaluable. So you're going to have local distributions, and I created a taxonomy of this, but domain's important. Outcome. What exactly defines an outcome? Like, before you do something, you're like, what is it I'm actually doing? Because I'm about to spend money doing it. This isn't a Google search where it's incrementally free. Like, so every time you do these things, whether you're an enterprise at scale or you're just, an average guy, like trying to figure out what's a SK Hynix, as you said, like, define what success is before you start. And like, a lot of this stuff is like not natural, right? And then you have priorities, as I just mentioned, like what's valuable to you for this outcome. And then you have this whole thing that we've talked about, and I talked about at length in, I think my last paper on the other 1720 bubble, this concept of non-ergodic versus ergodic processes. You have to ultimately have a filter for that, because think about the case of the lawyer who used this, right? Did a legal brief with it, brought it to the courts, and then they found out, this isn't even your work, got disbarred, lost his job.
Some kind of case law had been hallucinated or whatever, yeah.
Exactly. So you're talking about hallucination risk, or like, false positives, essentially, where the model thinks it's this. And so when we move up models, and then, the marketing machines like, oh, Fable Mythos, it's God, it's Sentinel, what it's really saying is the error rate is declining. But you have to remember, the thing is like, to go like this concept of governance, basically, even if you're at 95% success rate, that's 5% not, which on a one coin flip basis is fine. But if you go to 100 or 200, which what Rupert just said, which is I want a repeatable process, you're almost guaranteed to have like a ruining like hallucination. Now the question is, in stock research, how much do you weigh on it, whatever. But like, if you're putting output without a human layer, like you need to like understand you're really, really like risking that left tail event within usage of these models, which is nobody's talking about that within thinking. Maybe internally they do, but like I don't see anybody putting that cost, which is a hidden cost, but a very real cost, as that, you know, these lawyers who've gotten caught using it like have found out. You know what I mean?
Yeah, and even we're taking it out of sort of, you know, high pressure courtroom scenarios. If people are building agents to do really simple things like booking travel itineraries, right? The tolerance in terms of user experience for a single error, right, is incredibly low. And you can bust trust in that very, very quickly.
Absolutely. So you're like thinking about this, like, all right, there's a whole bunch of work that has to go in before you use this. And you know, maybe Rupert could think about it as like, define what you're looking for your intern or you're the analyst you're trying to hire, and put it here's the job description. Here's what you need to be able to do. Here's the background. Here's like whatever. And you have to really talk to it like that with like constraints, goals, and that's the kind of language and understanding it thinks of. And so basically, you know, you have a different way of measuring this is what I came up with. You know, you're talking about like right now, if you guys go through earnings calls, there's so many counterfactuals that dominate the narrative. Well, we didn't have to hire these people. Well, how do we know that? There's no actual baseline. So you're going to have to calculate, have something where you have before it happens, here's what I want. Here's the baseline. And if you don't have a measurable baseline, then I guess you could use another AI model. But like all this stuff is very nuanced, localized. Like this is not obvious, right? Like, Rupert, like, and I apologize for going densely into this, but like this is actually a better way of like calculating it. You put in the expected loss function, you put in this concept of a baseline of humans, and you're starting to get closer to where you would be versus, you know, these bank guys all come on and say, well, you know, we had costs grow less than, you know, income, or it's like, okay, dude, there's a lot of things behind that. And maybe you're just trying to drive that narrative to allow you to do this spending. And, you know, basically we're going to put this all in the show notes so you can go through this. I put a lot of detail in it, but like, it's a filter. Is there a counterfactual? Is not a counterfactual? Like, here's something that everyone can understand. What's the quality cost, you know, frontier crave? Yeah, trade-off. Exactly. This is something everyone can understand. Like, why do I use Fable as an example? You're saying all your users are using it. You're using it because your expectation is it's the highest quality error reduction model. And then how much am I willing to spend on it? Well, everyone's using it right now because you're getting it for free. Or you got $20 subscription and you're getting thousands of dollars. You max it out. Like they're going to have if we could see the daily P&L at Anthropic right now. By the way, I messaged Rupert and a couple others. It was funny to wake up this morning. Oh, we're extending Fable another week. Because I don't know if everyone saw Grok 4.5 came out of nowhere, like the Phoenix, and rose. And let me tell you something, that model's legit. I used it over the weekend. It's Fable-esque. It's very good. And I had ridden those guys off. So it just tells you that like Chinese LLMs, Grok, you know, Meta came out with a model. Like it's just every day we're going to hear more guys trying to say that. And if you're like spending this much money to like be like, we're the best, well, your lead's like 3 months, 4 months. That is not a comfortable situation.
There's no value to the moat. There's no value to the moat.
Yes.
If you can only hold an advantage for just over a quarter, right? What does anyone pay for that?
Well, that's, I think, a great question. Like, because I think it's the most important question is, yeah, Anthropic is very valuable, very good company of smart people. But what if they're all going down the wrong business model is the question that like I think is going to have to become of, hey, right now, tech guys are cared about tech. And I work with some tech guys and engineers, and they're focused on, does the system work? How do we make it work? What about like, and then the funding guys are like, tech guys got it. Satya's smart. You know, Zuck knows what he's doing. And there's this like faith-based believing thing that goes on that they couldn't be wasting this money, even though Zuckerberg's already proven that he knows how to blow CapEx. And so then we get to the situation of like, the market doesn't understand the technology. A lot of people, the guys on the technology side just assume the capital is going to be there. And so what I'm trying to say is ultimately the enterprise got to buy. right? Like the enterprise has to be comfortable with this. And you know what they are not comfortable with? Their data just floating around. Like, and so we'll get to the governance part, but like basically real quick to talk about the left tail. And again, we got Dave Dredge coming on. I actually sent him this. So like, Dave, you'll like this. But remember, old Peters was the guy who kind of really formalized a lot of this ergodicity of like, hey, is it an ensemble average or time average? If it's time average, you have to worry about not the average expectation of what's your path. And the path is kind of what matters. And again, this is just an example of the lawyer who uses it in a legal brief is effed. If I'm doing a research, I kind of like failure because it's like, oh, I figured that out. So again, it comes back to like what you're using it for has different, left tail cost factors. And so none of this calculating ROI is easy.
And interestingly, all of the total addressable market expectations are based on markets, valuable markets that are most exposed to this tail risk, right?
Correct.
So the people that need to use these LLMs, these models the most, potentially in terms of productivity gains, are the ones that really can't afford to. That's where I'm getting to.
And just remember, this is just a real simple thing of like the ensemble average is like, oh, GDP was this over time, but like there was a lot of people's lives who were ruined after the GFC, lost their houses or, whatever. Like, and so just remember when economics teaches this like ensemble average, but your path is all that matters to you as in your life, basically. And we talked about that in our last episode with Dave of like, when you go into the casino, on average, casino is going to win, but there's going to be a couple guys who are making a ton, and there's going to be some guys your money's gone real quick. This is basically just a filter. You can look through that, but it's like you're going to have to identify the domain. You're going to identify is it organic or non-organic. Like there's a whole process to this thing, and then the governance of like everyone heard the story about Amazon or whoever it was blowing $500 million of tokens in a quarter, right? Was that either Q1?
Uber. It was Uber. Yeah.
Yeah. No, I think Uber said they blew through it. But has it come out who did actually spend? I think of this quarter, we'll find out who actually spent it. Anyways, it doesn't matter. Point is, they didn't have a filter. They're like, yeah, we just went hog wild. And so having governance over these things reduces that like error function. So you put in more things to say, oh, well, it's elevated to a human level. Or, hey, we got to run more loops and get more models to consensus on it. And like, again, that's more tokens, that's more costs. But like this, so you don't even know what the optimal number of runs are for a model, right? So think about that, right? Like how can you calculate ROI if, again, back to the atomic unit task, how many runs is it going to take? So these are all wild distributions, all local wild distributions. And so you have to understand this is wildly complex. And so it can't really be defined. And then like, maybe to promote a little bit, like there's the upper stack is what's going to define this. And so, I was reading about XPO, the trucking logistics company.
Yep.
They've done really well. Like they had huge returns so far in their ROI. But you know what they did? They designed it all from the measurement level right off the chute, included the data memory level, which is what we're doing at Second Brain. They put the constraints and they made sure you can measure outcomes. Define outcomes, measure outcomes. Like they put it all in, and it takes longer to do that and it's more expensive, but they're getting much better results that are making their business better. They're realizing operating margin expansion. There's other guys who just aren't even close. And then I don't know what episode it was, but a couple episodes ago, I put that thing about from the percentage of S&P and earnings calls where anyone saw any meaningful ROI was low. And there was like even less that like even knew how to or measure it. You know what I mean? It was like, we're just at the measurement point right now. We're not even at this implementation, which can take 6 to 24 months, depending on the size and scale of your firm. And like, this is just kind of a equation that talks about that. And then, basically the memory layer, everyone want a good story. I tried to get Rupert to use a memory graph and he downloaded all the subsects. Like, this is a real pain in the ass right now. That's the thing, it's a pain in the ass to create a Wikipedia for all your data, label it right, that then it can actually pull the context in. And this is ultimately when this is solved, those memory stocks are going to be back on their ass and they're going to be asking Rupert to come off the bench and refinance SK Hynix once again.
It's quite funny. I mean, you're referring to the week of my life that I spent sort of putting my archive into an obsidian vault which, by the way, since completing that task, I have not gone back into. So this stuff,
that's a great example. You wanted to
yeah,
do it, and there was a friction that it was just too much to get to the point of learning how to do it. That one's also a like stateless model and vertical. Like the models that we're building in Second Brain, and what's going to happen is a temporal model, which is like the graph changes over time. So you introduce the concept of time into it. And at the enterprise level, this can be wildly valuable. This guy changed,
yeah.
this guy changed, because the decision wouldn't be the same if you had Rupert as the ECM captain versus whoever replaced Rupert as just like a simple Goldman Sachs example.
Well, apart from anything else, at the moment, you know, so many of these models cannot recognize that what I wrote 3 years ago on the yen versus what I wrote last week on the yen, you know, that prior view has to be heavily discounted. Yeah, maybe mention it, but if you come back and say, you know, just because I found that first, that's your core view, right? That's a problem.
Huge problem. Huge problem. And so, you know, basically here's the grid or the blueprint or the roadmap you got to do. This is not easy. Like to use these, basically what I'm trying to tell you is like over the last 8-9 months of like working with an AI company, I've been back in grad school, like a fire hose learning. And like you go into it thinking like, oh, I could just talk to this thing like I talked to the squirrel and it would just magically give me this stuff out. And then like, you know, thousands of dollars of tokens later, you realize, you know what, I need to figure out exactly how to use this thing properly.
I should have just called the squirrel.
Right, but the output layer collapse is real. You know, you guys who watch our show, it helps.
But meanwhile, the clock is ticking, right?
Right. So that's kind of the takeaway here is that you bring that up real quick. Is that so? What I just told you sounds probably complex. Certain enterprises are realizing this. Certain realize that like Uber, they realized they didn't do it right. They spent too much money. They got to fix their system. Well, these things don't fix overnight. You need solutions. It's just the taxonomy, the labeling system, testing it, and you're going to have to test certain groups within your firm versus other groups. That takes, I don't know, 3 months to 6 months just to get an A/B test. And yeah, back to what he just said, it wouldn't matter if it was all equity finance, but this is a finance by hyperscaler cash flow and credit markets, specifically private credit markets, more or less, right? The PE
and
guys,
increasingly the public bond markets as well.
And now finally the public bond markets, right? So we got a debt component to this, guys. And there was a great paper called The Second Derivative by this guy Groundbreaker on Substack. And I'm about to publish my paper on the British Railways 1840 versus this current thing. And he was saying it's 2008. I'm saying it's more like 1840s. There's a little bit both. The credit component is still not nearly what it was in 08, but it's real. And the question will ultimately be, well, we have a lot of people who don't understand useful lives of GPUs. A lot of people understand everything I just talked about. A lot of people who are just kind of doing faith-based investing, watching price go up, if you will, and not understanding there's a real credit side, capital funding side. And so and again, I believe in the technology, but I'm just trying to tell you, like getting from I don't know anything to systemize at an institutional level, that's just going to take time. It's going to take more time than people realize. And you got to remember the agents really only came into being earlier this year. I mean, OpenClaw was like a Q4 25 phenomenon. And then everyone's like, wait, why weren't we doing agents? And it reignited the whole AI. Because remember, this thing was getting going, then the war happened, and then it took off, right? Like that's essentially how this year went. Like the AI bulls didn't. That's maybe why the S&P didn't go down that much. They're like, we're not selling. We're gonna get paid once this thing like fixes itself, and they clearly did, right? That was the right call. And so yeah, again, remember, debt introduces time. Negative free cash flow introduces funding needs. So this is going to become by the day more and more capital market dependent, and that's why I created that CapEx monitor. Which, if you want to find, I give it to my subscribers. I'll give it to the Squirrel subscribers if you ask him. And basically it has everything. It has change logs or scenario analysis, and they're like built up a proper website. And so this is happening, and like we're just kind of at that point where like I think people don't want to acknowledge it's over. It's like that period at the end of the party from like 2 a.m. on where like some guys are still hanging out there and it's still fun, but you know that there's a decay curve coming from like every minute on. Like the fundamentals of it are, there's one guy leaving, the hot girl leaves, etc. To use a Benny in his 20s analogy.
Yeah, even in my 20s, I'd left 3 hours earlier. Anyway, listen, we're going to put all of these slides because they're quite dense. They're all going to be in the show notes. Reminder, Dave Dredge joining us on Thursday. I think it could be a really interesting week to have him on again. Things kicking off in Japan, which is really his sort of ground zero for where the next thing happens.
How is the yen trading tonight? Do we see? It's up a little bit.
I haven't got. I've just shut down my screen.
The beach ball.
The beach bull. Well, let's see. That beach bull might get a pinprick if we start GPIF allocations changing. Anyway, that's all from us. 35 minutes, we're done pretty crisply. Benny and the Squirrel out. See you Thursday.